Financial wellness is a measure of your overall personal well-being as it relates to your money. As an independent professional, there are many ways to improve your present situation while preparing for your future needs. Budgeting and finance techniques help you manage your income and expenses, maintain your credit score, and make the most out of your money throughout the year. Real estate investing enables you to grow your wealth through investing in the assets you know best. Succession planning refers to the preparation of an exit strategy for when you intend to leave your business. All of these aspects contribute to retirement planning, which empowers your investments, puts your mind at ease, and helps ensure that you're financially secure after exiting the workforce. Financial wellness is an ongoing journey, and the National Association of Realtors Center for Realtor Financial Wellness is here to help you navigate the path to success.
Welcome to the second of 3 webinars made in partnership with NAR's Center for Realtor Financial Wellness. As you registered for this event, you will receive an email next week which provides a link to this webinar on YouTube, plus the complete slide deck from today's presentation and links from today's featured speaker. We encourage you to ask questions. If you notice at the bottom of your screen, in the Zoom screen, there is a Q&A box at the bottom. Questions will be answered through that box at the appropriate time. At this time, I would like to introduce you to our moderator and the person behind bringing these important financial wellness webinars to you, our 2021 Maryland Realtors President, Dee Dee Miller.
Thank you, Dan, and welcome Maryland Realtors and guests tuning in today. This is our second webinar in our series of 3 focusing on Realtors Financial Wellness. We have over 500 registrants today, possibly a record, so hopefully we will continue to see that number tick up as participants tune in with us today. So I'm very excited to say we have Michael Simpson with us. And Michael is the leading authority on commercial and investment sales for over 30 years. Thousands of real estate agents, brokers, and investors from around the nation have sought after and greatly benefited from Michael's training. Michael is the founder and senior instructor of the National Commercial Real Estate Association and an internationally recognized expert in commercial real estate sales and leasing. The National Commercial Real Estate Association is a national training, consulting, and coaching company which provides real-world strategies in a university setting dedicated to being a key resource for residential agents, new commercial real estate agents, and brokers who want to provide training and resources to equip their team to generate additional revenue from commercial sales and leasing. The effectiveness of his coaching and curriculum is widely attributed to his massive personal success in residential and commercial real estate, both as an agent and a broker. Michael enjoys the distinction of being named as one of the top 1% of agents in the US and one of the top 3 commercial brokers in California and Hawaii, which sounds really nice right about now. Welcome, Michael.
Thank you so much, Dee Dee. Great job. Well done on the intro. And Dan, and thank you so much for having us here today and giving us this opportunity. What a great opportunity it is. And welcome, Maryland, to our online version here. Hopefully you can see my screen okay. Dee Dee, can you see the, okay, perfect. So what you all should be sharing, seeing our slides now. And I want to just start by, again, thanking everybody for your time and for attending this. I was talking with Bill Brown, past president of NAR, when all of this came together, when we were first approached, I think about a year ago now, at least. And he mentioned that such a small percentage of real estate agents, I want to say 50%, I don't remember exactly the number, but I was really shocked by what he said. About 50%, pardon me if my number's not exact, but it was a very low number of the real estate agents retire and don't even have one asset, not a home they own, no rental property, nothing. And it just floored me because I was thinking, my goodness gracious, gosh, guys and gals, we do all these deals, we see good deals, I know we do, and we think about buying them, or we talk about, well, I should, and I know will in the future, things like that go through our mind. And it's, in a lot of cases, we just never do it. And if that number is half, that's just a terrible number, and we've got to fix it, because, you work so hard all your lives and bust your butts and you do all these deals, and then what, right? Then you try to exit, and it's really difficult to exit and be able to retire. And last year when COVID hit, I think that was a wake-up call for a lot of people, especially in the real estate industry, who play check by check, commission by commission in a lot of cases, because you probably had a wake-up call. I know I certainly did in terms of our business, because we were doing everything online, live. I mean, we were doing everything live, and all of a sudden we could no longer do anything. So in other words, our business was shut down. We were stopped. And our sales here in California, I'm in California, we weren't even deemed essential for a while. So I know that a lot of my friends and peers were going, oh my gosh, I can't even get out and sell right now. What am I going to do? Right. And so that's what this is all about. It's about building wealth and making it a priority for you and your family, so that when you stop working, you have money coming in. Okay. Not if you stop working, when you stop working, right? Because sooner or later, we're all going to stop working, like it or not. And then what? So it's really something you really want to focus on and make a priority. And just, I'll tell you a quick story. I'm in my 50s now. I'm 55. I just turned 55 this last year. And boy, when I hit 50, oh my gosh, all of a sudden, that it starts going off in your mind. You start going, wow, things don't function as much as good as they used to before. You get a little sore after workouts. You start forgetting more. Things like this happen, and you start thinking, what am I going to do here? How close am I to being able to retire if I want to? And it wasn't until about 50 for me personally, it really, really kicked in hard. Thank goodness I did some things early on in my career and bought some investment properties and bought some brokerages and franchises and things, thank goodness. But I got to be honest with you, when I got into real estate about 22, and I didn't care about anything at that time other than girls and having fun and drinking, and that was basically all I cared about at 22. And so it was fun, getting in the business was a lot of fun, and I just wanted to have a lot of fun. And I really wasn't concerned with anything other than making money and having a lot of fun. I had a deal, and everyone has a story like this that you can tell, or somebody who does. I had this deal in Hollywood Boulevard, you guys, 6 units, Hollywood Boulevard. I listed this property for $600,000 back in the 90s, and the owner was so anxious to sell this property, and all I could think about was doubling that transaction and the commission. That's all I could focus on, was that in my head. And then I look back at that now, what 6 units on Hollywood Boulevard is worth today in today's world? It's probably, $3-4 million. So should I have probably tried to figure out a way to buy that property? Yeah, absolutely. And what would my life look like had I bought that property at that time? So we want to think about those things all the time. Think about the ability to get your hands on these investments that are out there. And I'll also say real quick that stop with the excuses. Michael, I don't have enough money. Where am I going to come up with the money? Stop that stuff, because and I know that you can figure that stuff out. There's ways to get around those things. And that's maybe another class, maybe another conversation. But if you just put in your head, it's a priority that I need to do this, you'll start finding ways to get it done. So that's what I'd like to mention to you. I like to always share that story, and everybody has a story. Dee Dee did a great job of explaining who I am. Basically, I started real estate in 1988. And I was a residential real estate agent. And what happened was I just quick bring up speed here is I got a commercial lead, and it was a commercial transaction. And somebody came to me, one of my residential clients, and said, "Hey, you just did a good job on my mom's house. Can you help me with this 6 unit? It was 6 or 7 units. I can't remember, but it was a commercial property. Can you help me sell that?" And I said, "Well, sure, of course I can." And I had no idea what I was doing. And I fumbled my way through that transaction. I started asking for help from other people in my industry that were focused on commercial real estate and investment sales. And nobody really wanted to spend any time with me. They were just, I'm too busy. They just didn't want to help me. And so, I got a little bit of help, but I really fumbled my way through it. But I fell in love with the transaction. And what I like about the investment side of the business, commercial investment properties, what I like about that is, is one it's less emotions. It's not so emotional. Like that residential space can be so emotional. The buyers, the sellers, oh my goodness, and I get it. You're right. I'm one of the things I'm doing right now is I'm in the process of selling a couple of my personal rental properties and getting out of California, like a lot of Californians are. And I'm going to purchase a triple net in another state just because of the legislative, risks that are going on in California. So you've probably heard that a lot of people are doing that. But it is interesting because I haven't sold any of my properties in a long time, years. I've just purchased, acquired, and just wanted to hold. And now I'm in the process of that. And it's, it's a little stressful because it's personal, right? And so when it's your personal residence, it's definitely more personal because it's your home and it's people's homes. And so those transactions, you guys all know this, tend to be a little more emotional, where the investment side is less emotional, more numbers, more spreadsheets. Does the deal make sense or not? I like that. I like that part of the transaction. I like the fact that it's not, when I first started in real estate, I had a farm and we had 1,000 homes in our farm, and we held an open house every weekend. And I had a little black truck that I would drive around, and I'd put literally 30 signs up literally every weekend, and I would just leave them up. Now we can't really do that anymore, but I could at the time. And I would just leave them up all weekend, and I'd open house every single weekend and evenings, right? And so in commercial real estate and investment sales, it's not so much like that. It's much more 9 to 5. So I like that side of the business. And I discovered that going through this transaction. And then I took this class. I had a flyer in my mailbox to take a course, and I thought, wow, what a sign. And so I ended up taking this class, and I just fell in love with the class. And the instructor called me and said, hey, if you come over to my office and help me build a commercial division, I'll mentor you. And so I thought, wow, what a great opportunity. So I go over to this RE/MAX office in Seal Beach, California, started helping him build a commercial division. I time blocked 2 hours a day for commercial investment sales while I did my residential business, which, by the way, I was doing about 100 deals a year at the time. So it wasn't easy. But that's how I got my commercial investment sales off the ground. And the next thing I knew, I'm exploding with commercial investment sales, having a lot of success. And I was going to bring in Stephen Moraldo, who's on here. He's my business partner, to take over my residential sales at the time. And then we were introduced to a Keller Williams franchise, which we opened and operated for, 15 years or so. And then I just couldn't keep up with it all. It was way too much. And so I started bringing in other people to help me operate my franchises. And this last year, I sold everything after COVID and went independent. And so that's my background, that's my history. And because I wanted to focus on sales, the big deals, and also on my coaching and training and speaking company. So that's just kind of the background of how we got here. By the way, Dana is also on my team. Dana Landaveri is there, and she handles a lot of our customer service stuff, things like that. So scheduling, calendaring. If you have any questions about anything, that would be the go-to for you, would be Dana, and she can drop her email in the chat for you. So if you guys have questions or want to get more information on anything, you can reach out to her directly. Great time to really add investment properties to your portfolio of services. And here's a couple of reasons why. I mean, if you just look around, you guys, the future's here, but it's unevenly distributed right now. And we're not all in this together. I kind of chuckle at the commercials out there when people say, well, we're all in this together, because I think that's not true. I just say, I'm like, no, that's not at all true. If you think that's true, look at Amazon. Look at the different spectrums here. These billionaires are making billions of dollars more every month, literally right now. They're just exploding in a lot of cases. And then you have the other side of that, where you have people in food lines and you have people out of jobs. We're not all in this together, guys and gals. We never will be. It's not equal. It's not going to be equal. It never will be, because there's transfers of wealth. And that's what we're experiencing. There's this huge transfer of wealth. This is probably my third market shift. The 90s, 2008-ish. Wow, what a shift that was. And then now we're seeing another huge, massive shift right now, aren't we? And you're seeing people making a lot of money and more money, and you're seeing people on the other end of that making less money and everything in between. So where do you want to be? Do you want to be on the side that says, wow, what a huge transfer of wealth, what a huge market shift, but I'm losing money and my bank account is shrinking, or do you want it to be the other side of that, where it's going, I'm taking advantage of this, I'm exploding, my business is doing great and things are going well, I'm growing? What do you want to be? Because it's all about you and your mindset, right? And then you got to get the education to know how to do it. But it really is a huge transfer of wealth. And it's important that you understand that. So when COVID hit, what we did is we shifted everything. We're a training company, consulting company, and we just stopped and said, you know what? Now is a time to teach people how to take advantage of the situation that's out there. And how you do that, I'll just read this to you. Unemployment, lack of significant job growth, and limited capital are all working together to recalibrate the real estate market. A skilled and knowledgeable professional who can work with landlords, tenants, and even lenders will be extremely valuable during this time. So see, when the market's really hot, buyers, sellers, especially sellers, they don't feel like they need a real estate agent because, what do I need you for? What am I paying you for? The market's so hot, I can just stick a sign in the yard. It's kind of their mindset, right? In a lot of cases, where when the market shifts and things don't sell as much. Now, keep in mind that we're talking about different, product types and different markets right now when I say things like this, because the residential market, I understand, is still smoking hot, right? So I understand that across the board. Sure, you have pockets that are not as hot and pockets that are hotter, but like everywhere. But across the board, residential real estate is selling pretty hot. I'm talking about investment property. I'm talking about some of the commercial transactions that are out there and what's going on in those markets. And those owners are more receptive now to having conversations with real estate agents, because they don't really understand what's going on. They don't really know what's happening with everything right now. So if you look at this, you can see you've got these eviction moratoriums. In some states, they differ by county and even by city within the same county. It's a good idea for real estate agents to learn this stuff and understand what's going on, so that you can be savvy at investing yourself. You have to know what you can and can't do. Some cities and counties have imposed eviction moratoriums only on residential property, and others on both commercial as well as residential. And sometimes, even when the moratorium covers both commercial and residential property, the type of property is handled differently. So if it could be residential is handled differently than a commercial property, for example, in the same city and county because of the moratorium. In some places, the eviction moratorium imposes obligations on the tenant in order to receive the protection of the moratorium. And in some places, the landlord is obligated to notify the tenant in advance of the tenant's moratorium rights. I just told you how I'm going through some sales on some of my transactions, some of my properties, my rentals. I had to get some counsel, really, because I've got one as a Section 8. So it's confusing. Compounding the confusion are separate court closures and orders not to issue summons in unlawful detainer matters, or to top it all off, the orders and moratoriums would change them from week to week or even month to month, day to day. So again, skilled, knowledgeable professional gives you value. We always talk about being a consultant versus selling, right? So when we're talking about approaching owners for the purpose of being a real estate agent to help them sell, or approaching owners from the standpoint of being an investor, either way, you want to do that with consulting, in my opinion. And how you do that is you've got to be able to help them. But that's what consulting means. So let me help you, right? Instead of sell you. So how you become a better consultant is you get better. You get better and skilled up and practice and understand what's going on in the industry. So good for you guys for all being here this morning, this afternoon. In all of our courses, we always have handouts that we give you. And in the beginning of almost all of the handouts are terminology pages. And the terminology pages help with some of the common formulas and calculations and things that you need to understand. So I'm just pointing out here that cap rate is something that's always confusing to people. They don't know how to calculate it. Gross rent multiplier, certainly return on investment is on the other page. Debt service payments. So I want to point this out here. In residential real estate, we call our payments mortgage payments. In commercial real estate, the lenders and the investors call them debt service payments. And debt service payments are on 5 and up, right? Residential is 1 to 4. Commercial, we go 5 and up. So we're just going to start saying debt service payments. So when you're talking to people, if I own a commercial property, you should speak the language to me, right, that I'm used to hearing in being a commercial investor or a commercial broker. And that language would be a debt service, would be one small example. There's so many examples of just language. And I'm not going to get into language right now. I'm going to go more through some of the basics and numbers with you, but we won't even talk about language today. But think about it, what is upside potential? What does that mean? And value play versus vanilla, horizontal versus vertical investing. These are all common terms that are thrown out by investors on a regular basis. ROI, right? IRR, all this language, you really have got to know that, in my opinion, or else you won't get to the table. It'll be very obvious that someone's talking to you and you're not using the right language, or they're using language and you're not understanding. That'll become very evident right away. So this is what I'm talking about. Get skilled up, understand this is only an hour today, right? So I'm going to throw some good stuff at you, but your journey is just beginning. If you're new to this and you really want to get into this investment sales, your journey should be just beginning. Here's an example of what we're referring to when we talk about numbers. So when we are dealing with values in real estate, there's four ways to determine the value. And maybe Stephen can drop this in the chat. Didi, if Stephen types this in the chat, will everybody see it?
No, Chief, there's no chat.
Oh, that's right, there's no chat. So, okay, so I'll just say it several times. So there's four ways to determine value. Make a note of this. And then you're recording this too. You guys are going to be able to get the recording so you can go back. There's four ways to determine value. One is the comparable approach. Two is the cost approach. Three is the capital asset approach. And four is the income approach. So I'll repeat that. One is the comparable approach. Two is the cost approach. Three is let me say it again. One is the comparable approach. Two is the cost approach. Three is the capital asset approach. Four is the income approach, okay? So when you're looking at a deal in terms of a potential deal and potentially buying this property as an investor, you want to look at this thing and say, okay, what am I going to be using? Which approach? See, in residential, it's pretty cut and dry. In residential real estate, I'm just going to look at comps 1 to 4, and I'm going to see what they're selling for. And it's that simple, okay? But when it becomes an investment property, the game changes. Now we're talking about rents and income and returns. The game changes, okay? So, but you could also look at something that maybe you're going to convert it. You're going to use it for something differently than what it actually is right now. So open your mind, be open to all the different possibilities. I mean, I bet if I questioned or polled some of the audience, you would have a story of how you or an investor or somebody you know or knew bought a property and they came up with this great idea. And they're like, look at what they're doing to that property. Oh my gosh, especially right now when you're going through a market shift and a COVID adjustment where you've got these motels, hotels, Holiday Inn, get it? Motels, hotels, they're not operating at high levels right now. They're struggling, they're going bankrupt. You have some retail that's not doing too well, office space. What's going to happen with all that stuff? Well, it's got to shift. It can't sustain. It's not going to remain the same. So what you have is you have a lot of people trying to figure out what to shift to. So just be open to understanding that it's not always this simple, hey, residential approach. Okay, so you might be looking at one or more of those methods when you're trying to determine whether you should purchase the deal or sell the deal. Income approach, comparable approach, capital asset approach, cost approach. So comparable approach 1 to 4, we use that for residential. Capital asset approach is for risk of loss. If I have $2 million tied up in this asset here, I've got $2 million that I can't use to purchase another investment of some sort. So there might be a risk of loss here. The cost approach is for vacant land, which is pretty complex, but just to kind of simplify it, if I have a lot and it's zoned R25, it means I can build maybe 25 homes. So what am I going to do? I'm going to use the cost approach. I'm going to say, what's it cost me to build 25 homes? And what can I sell them for when they're done? What's it going to cost me to carry 25 homes? The carrying costs, the construction costs, the holding costs, all of that. And I calculate it all and I say, when it's all said and done, I want to make, X amount of money from that deal. Well, that's the value. That X amount of money is the value of that land. That's the cost approach. Really quickly explained. Obviously, it's much more complicated than that, but that's a quick explanation. Then the income approach. The income approach, whenever you're looking at income property for the purpose of its income, you should be using the income approach, because if I can get more income out of an asset, then I can get upside. There's upside, what we call upside. There's more value there because the value is determined by the income. So if you're looking at a rental property, do you want more income on the rental or less? And the answer is probably more. So understanding how that game is played goes back to numbers, right? Especially if you want to understand at a high level. So what you're looking at here, I won't go through all of this today with you, but I'm going to just kind of sprinkle some things at you guys and gals today. And then if you want to dive deeper into this, you can take one of our other courses. We do lots of things, lots of training. We do lots of training. Some of it's, longer, 1 day, 3 days. Some of it's intermediate, some of it's advanced, some of it's free, some of it's not free. So there'll be a lot of different varieties for you to explore if you want to. So I'm going to go through this, but again, I'm not trying to explain it to you because it's just I need to go through this properly with you, and I will in one of our other courses. But I just want you to kind of get an idea. So, and we have assumptions when we look at real estate using the income approach. We're using assumptions. So I'm going to look at a deal and say, okay, how is it currently operating? Are these rents current rents, or is it some sort of pro forma, some sort of market projection? And that's what you're looking at here, current rents and market rents. And you always want to know from the other agent or the owner or whoever's giving you the information, what is it? Is it actually happening right now like it is here? Or is it some sort of market or pro forma where it's not happening, but you're saying, hey, this can happen when you buy it. See, you want to question that. Say, well, if it could be done, why aren't you doing it now? So current rents, market rents, seller carry. The gross rent multiplier is 8.44, the cap rate 7.31, and all of this is in the glossary of terms. So you could literally go through the glossary of terms and say, oh, okay, sales price divided by SGI gives me my GRM. So you can do this now that I'm explaining it to you on your own. Or you can go to a class with Stephen and myself, and we'll show you. We'll give you exercises and show you how to do it, whatever you want to do. The price, $750, down payment, 25%. 25% of 750 is 187.5. When we subtract the down payment, we have the first trust deed. That's 562.5. That's the loan, and we're amortizing the loan in this case at 9% over 30 years. But again, you can use any assumption you want, and that's going to give us the payment. Again, what do we call the payment in commercial real estate? Debt service payment. And that's where we're getting the payment, is we're amortizing the loan. Then we're honing in on the income. Now, just this part here requires a lot of explanation, right? But I'm, again, just going to go through it quickly with you. The scheduled gross income, you add up all the income of the asset monthly, multiply it times 12. We call that our SGI. Then you multiply that, in this case, times 5% to factor in a vacancy factor. That's where I'm getting 4,442. And then I'm going to subtract it. 88,000, subtract 4,000, leaves us with 84,000. 84,000 times 35% for expenses is 29,535. Then I'm going to subtract it. 84 subtract 29 leaves us with what we call net operating income, NOI, of 54,852. Then we subtract our debt service to get to our cash flow. And then we have a return on investment that we calculate, and what's called a debt coverage ratio that we calculate. All of this, again, is in the glossary of terms. Okay, so that's a really fast explanation of current rents, market rents. You can see on the market rents here, all we're doing is raising the rents. So, well, gosh, can we raise the rents on this? So I'm going to do what's called a rent survey around the area, and I'll tell you how we do that in one of our classes. But you do a rent survey or a lease survey to see if you can raise rents. Is there upside? Remember, the money's in the upside on these deals that you're looking at. And you can see here, yeah, I can raise the rents. So now let's take a look at it. What happens if I buy it and I raise those rents? and then you run the column again, and you're analyzing it that way. See, and so that's how you consider doing this. Now, you also have seller carrybacks in the markets that are really hot. So when the money's flowing, banks are loaning, everything's great. You have money, you have no real need to do seller carrybacks. It's just not real common. But when the market changes or shifts, guess what starts to show up? The need for seller carrybacks, the need for creativity. What's happening right now? Think about it. I just heard that interest rates are maybe being or might creep up again. Or I shouldn't say again, but might creep up a little bit, a half a point. Now, I don't know if that's true or not, and I don't know if that's going to happen. You know, sometimes they'll raise the rates, but it doesn't actually impact, you know, the loans necessarily. So I don't know. I just heard it yesterday in passing. I was like, you know, I hadn't heard that. But I'm hope not, because it's not a good time for me personally, because I'm selling and I'm buying, number one. But I don't think it's a good time. You know, there's a lot going on in our real estate market, you guys. I really think things are about to change dramatically, is my personal opinion. I think that the economy has been propped up a lot, and stimulus, PPP money, unemployment benefits, COVID bills, all of this. Now they can keep pushing more money out, and that will help. But at some point, we got to look around and say, wait a minute, there's all these people out of work, and there's all the commercial real estate stuff that's going on. How can things keep going the same? It really can't. And we also know that markets go up and they go down and they shift, right? Well, how long has the residential real estate market been going sky high? How long has this been happening? It's been happening for a while, hasn't it? How long does history show that those trends typically go for? Just look at it, just and use your own judgment, and maybe you'll see that the market's due for a significant shift. And so, who knows? There's so much demand. There's no supply in a lot of the residential stuff, you know, so I could be way off base. I don't know, but I'm just saying historically, it's the signs are there and the writing's on the wall, especially with everything that's going on. And I know that banks are tightening up, especially in commercial real estate. They're getting more stringent. They're not loaning at all on retail in a lot of cases. They're not loaning at all on hotels. So you've got some banks tightening up, interest rates go up, they could get tighter, right? So the reason I say that is because seller carries are really common right now with some of these commercial real estate transactions that are out there. And I've put deals together in residential real estate doing a seller carry that the deal wouldn't have gone together before had we not done that. So it's kind of a good idea to learn this and understand this at a high level. We'll teach you this in our 3-day course, but just to explain, you know, if I'm selling a property for $1 million and I'm carrying 10%, 10% of $1 million is how much? 10% of $1 million is 100,000. Okay. So if I'm carrying 10%, I'm carrying 100,000. The interest rate is usually interest only, deferred typically. So if I'm carrying a note, I'm loaning the buyer money, 100,000, and I'm doing it at 10%. Well, 10% of 100,000 is 10,000. So what my interest payment is every year is $10,000, 10%. Okay. Now you would divide that by 12 to get the monthly. And then that's how simple it is. I mean, it really is that simple. It's because it's usually interest only. You can see here what we did is we raised the price of this deal because the owner said, well, why should I do that? Well, we said, we'll tell you what, we'll raise the price. We'll pay you 11%. Where else can you get 11% on your money? And now you can see when I did this, the interest rates were a little higher. So at the time the rate was 9, and that's why we're at 11. So you can, you know, use your best judgment, but it's typically when you're carrying going to be, you know, couple points over the going in the industry right now. And then we deferred the interest. So there's no payment on the second trust deed. See, right? In that example I shared with you where I'm carrying 10% at 10%, my loan is 100,000, my payment's 10,000, okay? Every month though, divided by 12. Here, we're just deferring it. We're saying, look, there's a payment, and that payment is roughly 11% of 210,000, which is about $23,000 and some change. So every year, $23,000 of just interest is due to this seller, this owner, but it's deferred. So year one, $23,000 of interest is due, but it's deferred. Year two, $23,000 of interest is due, but it's deferred. Year three, $23,000 is due, but it's deferred. And then at the end of year three, all three of those interest payments are due along with the initial $210,000 in the form of a balloon payment. So it's a really attractive return for the owner, but there's risks, right? There's risks. Well, what are the risks? Well, what happens if the buyer doesn't pay me in 3 years and the loan is due, right? Well, I can foreclose, take the property back, so there are risks, and the risks would be, what does that look like 3 years from now? What does your market look like 3 years from now from this product type that you're selling? If it's a hotel, I wouldn't be suggesting an owner do this with right now in 3 years, because what's going to happen in the hotel industry in 3 years? Really risky. What's office, retail, what's that stuff look like in 3 years? I don't know, but very risky. If it's a single family house, maybe, right? So it depends on the who makes that decision, the owner of the property, right? Because they're taking the risk. So I always like to give pros and cons to owners and then let them decide, because it's their money. But there's times when this really makes a lot of sense. And then the other part of the risk factor would be a down payment, skin in the game. 20% down in today's market is probably not very much. But you can put down 30, 40, 50% seller carry, and they feel good about the market in the future for that product type. It's probably a good thing to consider. There's all kinds of ways of getting creative: master leases, AITDs, seller carries. I learned a lot of this when in the down markets, 2008, 90s. This is coming your way. I can pretty much assure you. I don't know if it'll be this year or next year or I don't know, but it's just, it can't keep going the way it's going. It's just historically really not possible. So understanding the creativity and how to put deals together and structure them is part of it's a really smart thing to do as an investor and of course as an agent too. So those are things that we'll teach you. Now, this we've given you, we give you this as an exercise. So we do a couple different things. We do a 1-day course and we do a 3-day course. Our 1-day course is a little more beginner, basic fundamentals like this, what you're looking at. And then the intermediate course would be our 3-day course, where we start saying, okay, now that you've learned some of those basic fundamentals, let me show you what you can do with those basic fundamentals and how you can market to people to make money. So those are just a couple things that we do. And when we do this, we always do, whether it's a 1-day or 3-day, we always give you exercises. So this is one of the exercises that we give you in the class, and we walk you through it. The price is $725, and we say, okay, it's 25% down. How much is that? And then everyone puts their answer in the chat bar, and Stephen goes through it. And Stephen is really who does the 1-day course, especially the formulas and calculations. And then you calculate the first trust deed, you calculate the vacancy factor, the gross operating income, you do the whole thing basically. And we're just helping you. We're walking you through, okay, glossary of terms. Oh, it looks like you did it the other way around. You need to take the NOI divided by the cap rate. You did it the other way around. So we're walking you through it so you're not struggling, which is what happens when you try to do it on your own. And if you're interested in taking the 1-day course, Dana, as a matter of fact, when you can, or Stephen, I'm not sure how we get them that information, but we'll get you the information on these courses so you can plug into them, just a link and how much they are and the dates and all of that. And then we give you blank answers, and then there's the answers. So you have this, you can practice this, you can do this on your own. But again, if you want to get guidance, then come see us at one of our classes. We have another one in here with a seller carryback that you can practice as well. So you've got some exercises in here. And again, the answers are right behind it so you can check your work when you're done. I want to focus mostly on systems and strategies with you today. Everything we do is systemized, and a system, save yourself time, energy, and money. See, if it's up to you, then it's going to break down, right? At some point, if it's up to me, it's going to break down. At some point, I'm going to get sick. I'm going to take a day off. I'm going to get too busy. I'm going to say, oh, I just didn't get to it today. Human, right? Where if it's automated, systemized, that's what we're talking about here. And then it happens no matter what. That's what we like to do. And we have 4 systems that I like to suggest. what we all should be doing is having conversations with whether we're looking for properties to list and sell, or whether we're looking for properties to buy. As an investor, we should have conversations with people to do that, right? And those conversations should be about 6 to 8 conversations, which is what you're seeing down here. But what happens is people don't do it all the time. They don't always have the basic conversations that we should be doing, looking for business every day. In other words, lead generating every day is what we should be doing. Because we get busy or just don't do it or whatever the case is. But the other reason is we don't have our business systemized. I love what you said, Dee Dee, about succession planning and how you are teaching that, because my goodness, the real estate agents just in general don't learn this stuff. I didn't learn it. I mean, I didn't know it. I was taught, right? Somebody showed these things to me and I was like, well, yeah, oh my goodness. You own a business. You got into real estate not for a job. You got into real estate to own a business, but yet we get in the real estate business. And I'm not talking about you guys, by the way, right now. I'm talking about all the people that are out there that aren't on the webinar that should be. That's who I'm talking about right now. Because what do they do in a lot of cases? They operate like a job, and then they stop working because they're done, they're sick, they can't do it anymore, or they're too old, or it's time, or whatever. And then what? They don't have anything because they didn't treat it like a business. They treated it like a job. And that's a very common, huge mistake. So treat your business like a business and operate it like a business, and then build it to where you can maybe sell it later. How many real estate agents do you know that were able to sell their business when they got out? I know like 2. It's like a really low number. I mean, it's just not common. Why? Because we don't systemize our business. So I systemize everything. It's how we did 100 deals a year in residential. There's no way we could do 100 deals a year in residential real estate without systemizing things or having a lot of staff. So one would be a way of getting listings. These are the 4 systems I like to recommend. One's a way of getting listings. One's a way of getting buyers, which is the internet. Sphere referrals is past clients and your existing clientele, which you guys all know this. You all know you should be contacting your past clients and existing clients, right? You look at this and you go, Michael, I know that. I know I'm supposed to be. But here's the challenge. The challenge is that it's not happening because it's not systemized. It's not automated. See, if it's up to me, it's going to be a breakdown. And we know this. How do we know this? NAR, according to NAR, what is it? 85% of all clients who were polled say that they would work with their same agent again if they could, but only 15%, roughly, don't hold me to these numbers, actually do. And the reason they don't do that, they don't work with that same agent again, is why? Because my agent didn't stay in touch with me. So, I know this, Michael, but are you doing it? No, according to NAR, you're not. And I'm guilty too. I got off track with this a lot because it's just, we have all these excuses why we don't stay in touch with our people that we know. We feel like we're bugging them, all kinds of reasons that we come up with. If you automate it, it just happens. And that's what we're talking about doing here. Automation. Everything is a system. Sellers, buyers, past clients. The 4 system, by the way, is market of the moment, market of the moment. And that stands for like this could be short sales, REOs, expireds. If the market's real hot, we should be looking at press release systems, marketing systems, maybe, right? The point is, markets change, right? They go up, they go down, they shift all the time. It's constantly shifting, the real estate industry. And when the market shifts and changes, you should know, number one, that the market is shifting. You, the professional in the industry, should be tracking the key indicators, unemployment, job growth, interest rates, absorption rates, the number of properties that are for sale versus the ones that are selling every month. I track that every single month in certain product types. And then I can see, oh my gosh, look at that. We have, 30% of our properties are on the market right now. How did that happen? Because 2 months ago, it was 5%. What's that saying? It's saying there's a shift occurring and I'm catching it because I'm tracking the key indicators, see? And then what? Well, then I'm going to start adjusting. I'm not going to keep doing things the same because the market is shifting, see? So, but what most real estate agents do is they wait until somebody tells them, oh, the market's shifting. By the way, it's too late. When anybody who's ever been through a market shift knows exactly what I'm talking about right now. It doesn't you don't get like all these signals saying, want, this is happening unless you're tracking it. Then you do. But most people don't track it. So all of a sudden it feels like, whoa, how did this happen? And then all of a sudden you're in a market shift and it's too late at that point. So that's what we're talking about here. Having 3 systems that are constant: seller, buyer, sphere, past client. And then the fourth, you're adjusting, you're changing, you're moving your business around. You're being really proactive with what's going on in the markets. I like these. This is the foundation of what we do. All of our classes and trainings are geared around this fundamental concept. And then we hone in on certain topics. Like it could be for the buyer. How do you do this, Michael? What is that? How do I work with investors? What do I say to them? How do I help them? How do I get investment properties for myself for buying? How do I sell investment properties? How do I help get listings that I can sell? And then past clients, how do I do this? So each one of our classes is geared around one of these systems, okay? But you should have 4 of them. Now let's take a look at, there's 3 different types of return on investment. ROI is return on investment. And there's 3 different types of return on investment. There's what we call CC, which is cash on cash. CC is cash on cash. So a lot of times you'll see, let's see if I have that here. A lot of times you'll have, I don't think I have it, but you'll see on the, there it is, ROI, CC. So ROI, CC is cash on cash. It means how much money did I put into the deal? And then what's my return on the money that I put into the deal? So you can see here, my down payment is about 200,000, 181,000, and my return on that money is 9%, which is pretty good, right? That's called ROI, return on investment, just CC, cash on cash, before taxes. Then you have ROI after taxes, and then you have internal rate of return. Okay, so those are the 3 different types of return: CC before tax, after tax, IRR, internal rate of return. Okay, so what I'm going to show you here real quick is I'm taking it, I'm blowing up the center and I'm blowing up the bottom, blowing up the center, blowing up the bottom. This is the center. You can see that the return on this deal is 2%. 2%, not very good. And the buyer, the investor that was buying this property, we were writing the offer for them, and they said, whoa, wait a minute. All of a sudden they stopped me in the middle of the offer and said, wait, Michael, 2%. Again, why am I doing this? Why should you buy a 2%, something that's got a 2% return, you guys? Should you, right? Maybe, maybe not. And so what I said to him was, remember the benefits of owning real estate. The benefits of owning real estate are taxes saved, interest paid, principal reduction, depreciation. There you go. There's a screenshot, or you can take that of that. Taxes saved, interest paid, depreciation. And of course, appreciation when you have it. But we don't always have appreciation in every zip code, every block, every market, right? And you can't count on it. You shouldn't count on appreciation because you never know what's going to happen and what might change. These benefits here, you should be able to count on as long as the government doesn't change their laws, which is being discussed. But these would be the benefits of owning real estate. And I'd really like to see us as real estate in the industry get better at talking about the benefits of owning real estate, because it's not just appreciation. And because a lot of people don't know this and understand this, they don't talk about it, right? And so when the market does not go up in value, it doesn't appreciate. The media says, see, I told you, you guys shouldn't buy real estate. You should buy jewelry and stocks and bonds. And, you know, it's just, I just disagree with that. I think real estate is really a fundamental foundation of investments, and it should be our priority for everybody. I really believe that and feel that way because there's so many more benefits. And I can have a pretty good argument. Can you guys have a pretty good argument with people about the different types of investments and why they should consider it? Again, getting back to skilled and knowledgeable. And you should know them yourself, right? You should be buying deals and looking at property on a regular basis. All right. So when you take those things into consideration, those benefits, what happens is it impacts the deal positively. So if you look at the bottom of that slide, remember I blew up the middle and blew up the bottom. Here's the bottom. We take the NOI, subtract the interest paid. So whenever there's a property that's being bought, a certain amount is going towards principal and a certain amount is going towards interest in any given year, assuming they're financing. And you can calculate how much of the interest is going to be paid and how much is going to be going towards principal. And then you can also calculate depreciation, which again is a benefit of owning any investment property. And when I'm doing this, I'm calculating the depreciation, I'm calculating the taxable income that's lost, taxable income that's saved, and then I'm plugging that in here. And then I can add in the principal reduction that's going towards the principal. And then I can add the total after-tax return. And now I have the total after-tax return on investment. So when that investor said, oh, wait, 2%, or when I said to you, should you buy something at 2%? And I said, maybe. And let's look at the benefits. Taxes saved, interest paid, principal reduction, depreciation. You can see your return's actually 8. How about now? Should you buy the deal now? Now that I walked you through that, maybe it's a yes, maybe it's a no. But this is what I'm talking about here, is understanding how those benefits impact the return and the deal. So we're talking about after tax here. Okay, before tax, after tax. IRR is internal rate of return. It looks at all the years that you've owned the asset and anything you've put into it, all your gains, all your losses, and then it calculates the total return based on all of that. And that's what a lot of your high-level investors will look at. For the typical real estate agent that's just thinking about investing, I would say, look, just focus on ROI before taxes, and then focus on maybe after tax. Don't get caught up in IRR right now. Just, deal with some basic fundamentals and start to learn, get your feet wet with investments and what the pros and cons are and how you deal with them. And then if you like it and you want to get more advanced, you can, right? Which is what I've seen with almost everybody I've ever worked with. It seems I was looking at one of my guys in Randall is his name. He's now in Dallas, and I met him in Long Beach. He's here at my office, and he was brand new, and now he's out there and he's developing real estate projects, and he's just taken off. It's so exciting to see people do that. So take it one step at a time, though. Okay. This is showing you this is huge, you guys, this part right here, and then we'll wrap up with this, and then I'll see if there's any questions. So if you've got questions, it's a good time to throw them in the chat, and then we'll spend a couple minutes answering any questions you guys have. I'll go through this last piece here with you, and then I'll be done and ready for questions. This is gold. This is just absolute gold. What this is called is it's based on a concept called diminishing ROE, diminishing return on equity. And what you have is this was a true story. It's a live scenario, the doctor scenario, we call this. The doctor buys a property for $1 million. The loan is $750,000. The equity is $250,000. The cash flow is $25,000. The doctor was doing pretty good when they first bought it. Then the value went from $1 million to $1.8 million. Now, is this realistic for a property to go from $1 million to $1.8 million? Probably, yeah, it depends. It could be shorter, longer, depending on the market and where it is and the type of property. But in time, the property will go up in value, typically, historically. And now you've got $1.8 million, the loan's $650,000, the equity is $1,150,000, cash flow essentially doubles. So think of how many people are sitting in this position right now. Things are good. The market went up in value. I'll tell you that the 3 properties that I'm looking at, investment properties, it wasn't just legislation. It was all of a sudden I looked at that and said, holy cow, when did I get so much equity that this now makes sense for me to do what I've been talking about doing? Because it happened, I didn't really even catch it. I didn't even realize it until I just started analyzing. Every year I'll stop and look, and it was like, wow, holy cow. And this is what happens. People in this situation think they're doing really well. Well, maybe not, because when you take our 3-day course, so by the way, in our 3-day course is what I'm going to get into more of the little more advanced stuff with you. Remember, 3 days more intermediate, more advanced. The 1-day course is more beginner. So the 1-day course is more fundamentals, cap rates, return on investment, GRMs. The 3-day course is more depreciation, and this stuff here that I showed you. This is more 3-day course and just a little bit more intermediate advanced. As is this concept here, this grid system concept. I'll show you how to analyze this deal using interest paid, principal reduction, depreciation. It's not easy, but we'll show you how to do this in our 3-day class because we have the time to do it. but I'm going to show you. So I'll show you how to do it where you can have an actual, analysis, a written analysis, paper or digital, that you can show somebody or present to somebody or really go through the correct way. I'm showing you the shortcut. The shortcut, take the cash flow divided by the equity, and that's a 10% ROE, return on equity. Okay, pretty good. Now take the cash flow divided by the equity, it's 4%. So what's happened here is this return is diminished. It's diminished from 10 to 4. It's going to keep diminishing, most likely. It's going to go from 10 to 4 to 3 to 2 until what? Until this owner sells this property and gets back over here and puts this money back to work for them. He's got all this dead equity. Maybe you've heard that term. All this dead equity is just sitting there. It's not doing any good. See, so this owner thinks that, in theory, look, whenever somebody gets to a 50% LTV, loan to value, or more, they can, or less, I'm sorry, they should consider selling the property, exchanging the property into something else. Because in theory, I can take this property, let's say it's worth 2 million, I can sell it, and now I take my $1 million in equity. See, $2 million in loan, that's 50% equity position. Okay, now it's time to start looking at it, because in theory I can take a look at my return on equity and say 4% is probably not acceptable for me. 4% is too low. And here's why: because I can take my property, sell it, take my $1 million and buy a $4 million property. Would I rather have a $4 million property or a $2 million property? And the answer is probably 4. I'd rather own a $4 million property. If my goal is to buy, exit, right? Do investors have exit strategies? Yeah, most investors are investing because they have a strategy, or if they don't have a strategy, they don't know how to put a strategy together. They're just kind of doing it, which is what most investors do, which is what we teach. We teach strategies, systems, how to write written real estate investment plans. Think about that. How many real estate agents are out there saying, hey, come to me, I can help you write a written real estate investment plan? I'm telling you, this is just absolute gold, whether you're going to invest for yourself or whether you're going to become this investment planning specialist in real estate that helps others, or a combination. It's just absolute gold, because these things are not taught in the industry at all. And it's because a lot of the agents out there just don't know it. Even your full-time commercial agents are not familiar with a lot of these concepts and strategies, you guys. Maybe the top 1%, top 10%, yeah, those guys and gals, yeah, they're really good at this stuff. But that's 80, 90% of the industry that's out there that doesn't understand this stuff. So it really is a good opportunity for you. That whole grid system concept is really something you should consider and should look at. So again, getting knowledgeable and skilled up is the way that you should go, in my opinion. Huge transfer of wealth is occurring right now. Are you ready? Are you prepared, you guys? I wish I was in the 80s and in 2008. I was just a little too young and wasn't quite ready. Now I am. Now I'm ready. I know what's coming. I feel like I have a really good idea of what's down the road, and I feel like I have a really good idea of how to handle it and how to capitalize on it and seize that opportunity. Now, we do a 3-day course. I mentioned to you, we do a 1-day course and we do a 3-day course. And when you do the 3-day course, these are some of the bonuses that we give you. I won't go into a big long thing with you, but we give you have 3 intense training days with me. You have software that we give you that you can use. You have designations that you qualify for that you can use that we own. You have the National Commercial Real Estate Advisor, so you can put these designations and the Certified Real Estate Investment Planning Specialist, and you can say, hey, let me help you with your written real estate investment planning strategies. You can put these designations on your email, on your websites, on your business cards. You get a copy of our listing presentation, and of course, we're going to give you case studies. This is what the software looks like. Here's the dates for the next 3-day training event, March 23, 24, 25. It's 9 a.m. to 5 p.m. Pacific Standard Time. Here's some other courses that we do in case you can't get to the one in March, but you can see here May and July. And then we also do an advanced course in August. So you can go from a 1-day to a 3-day to an advanced course and really be in a really good position to really do well with what we've taught you today. So Michael, how much is that stuff? Well, the 3-day course is normally $1,195. And if you go to our website, you can see it's $1,195. And usually we'll throw a half price deal out when we're doing these type of training events, which makes it $597.50. The one-day courses are $64.97. So if you took if you did a 3-day at half price and a 1-day, it'd be $662 for you. But because of Dee Dee and Dan and NAR, we are always throwing out special deals for the opportunity that they gave us today. And you can see we're slashing it. It's $397. And to give you some motivation to jump into the 1-day, we are doing a 1-day course next Wednesday, March, whatever that is, next Wednesday, March 10th, from 9 to 5 Pacific Standard Time. You can get it for free. You can get, if you take the 3-day course at $397.50, we'll throw in the 1-day course. Okay, that's today only. If you want to capitalize on that, get to Dana. We'll figure out here in a minute how to get you the information, but get to Dana so she can get you the links and get you registered. If you're not ready to do the $397, if you're saying, oh, I don't know, I'm not sure, then maybe just go to the 1-day course and take the $64, $64.97 and see, and say, hey, do I like this? Do I want to do this? Do I like Michael? Do I like Stephen? Do I like what they're teaching? And then you can decide to go to the 3-day after that. You just won't see the same price. That's all. But if you're sure and you say, look, I want to go to the 3-day and the 1-day and the 3-day, then I would do it this way. All right. So there you go. Again, there's the dates for you on these courses. And I'm going to turn it back over to Dee Dee and see what kind of questions you all might have for us today.
Yeah,
You
great.
do have,
Thank you.
I'm sorry, go ahead, Dee Dee.
Oh, go ahead, Dan. Do you want me to run down what we have?
Yeah, there's 3 questions in there.
Sure. Yeah, we've got a few questions for you. That was a lot of information. It's, as a residential agent, a little bit of that is feeling like you're drinking from a fire hose. So obviously getting in more in depth, on certain things is today was an overview for everyone, but we do have a couple of questions. Someone's asking, this is actually a really good question about bringing their own investment properties. Good for you, Robin. You already have some investment properties. And is it possible to bring those to a course that you may be doing in order to analyze their own properties and kind of walk through how they look right now?
Yeah, that's a great question. I would say if you want to do that, then, I don't mean to like push. I'm not trying to do that, but I'm busy, like really busy, right? And so is Steven, and we're super busy. I would say go to the 1-day and the 3-day so that you have a basic, we've taught you some basic fundamentals about what to look at and what we're saying. Because one of the things that's really hard is when people come to us and they haven't been to any training events and we're trying to have a conversation with them, they just don't get it. They're not understanding any of it. Now, some of you out here are experienced or have some experience. That's probably a little different, but yes is the answer. But I would just say, I would encourage you to go to a 1-day and a 3-day so we can at least speak the same language at that time. And we'd be happy to look at. That's very common actually, that comes up.
Good, great, that's wonderful. Someone else is asking, Ricardo is asking us, would it be smart to sell a rental property where you can cash $300,000 and do an exchange for a commercial property, considering the real estate market is too expensive right now? So he's basically saying a 1031 between a residential rental is what I'm understanding him to say, taking that cash and putting it towards a commercial property right now, where maybe you get a little more buying power in the commercial industry right now. I think that's what he's asking.
Yeah, Ricardo, great question. One of the things that I have always learned is that, I need to kind of understand more about people's goals and what they're trying to do. And this could be a real estate agent that wants to grow their business. They'll say, can I make money doing this and how fast? And it's just a lot of questions. What's your background? How much experience do you have? Do you have a database of people that are attorneys and doctors, or are you brand new in the industry? Same thing here is, it would be, what are your goals, Ricardo? Example. Okay. So I'm a fan of return on equity and the return I'm getting on my money. Okay. Return on investment, return on equity. And I own rentals in and around the Long Beach area, which has been just going crazy high, skyrocketing in value, right? But my returns have diminished dramatically because of the values going up. So if my goal was to say, it's okay, I'm not concerned about the return. I want to just keep banking on California going up in value. I think it will. Then I would not sell the properties, right? Because in the back of my mind right now, honestly, I'm thinking, if I sell these properties and the market goes up in value another $200,000 next year on these properties, I'm going to kick myself, right? But I can't think that way, because what's my goal? My goal is to get a better return, right? Secure my FFP. What's FFP? Financial freedom point. See, I'm 55. So now it's time for me to lock down certain amount of income. FFP is the amount of money that we need to make in order to sustain our lifestyle that we want to live, right? You guys should all know that number for yourselves. What is your FFP? How much money do you need to make every single month, every single year in order to stop working and live the lifestyle that you want to live? And for me, when I stop working, I'm not interested in, a mobile home somewhere and not doing anything. I'm interested in traveling first class and, 5-star. And so it means to me, I have to go from here to here with that number, right? A little bit, but it's different for everybody. And you should know that number. And then you can plan around that. And so again, my goal is to get that done, that FFP number in place. So this is my way of selling these properties, exchanging over here. I'm going to do a triple net investment in another state, and it's going to secure probably 70% of that number. And then it's like, okay, now I only need a 30%. I'm done, right? And so that's my big goal. So it depends on what your goals are, and it's more of a conversation, because commercial, if you're saying I'm going to exchange it to commercial, then that becomes okay, based on your goals, is that the right move? And then also, what type of product type should we be getting into if we're going to do that? And then again, that again is a conversation.
Great.
So in theory, it sounds great, but I would say it's really, I don't like to just throw out answers, honestly, because I could be way wrong, based on your goals and based on the equity positions and the returns, I could be way off basis. So I can't really answer it fully, but I hope that helped.
Yeah, no, I think that's great. Things to think about, but the big takeaway there is really just understanding how to analyze it so that you really can see what's in your best interest. And I feel like from this today, I'm sure there's a lot of residential agents who are on here as well, who maybe they want to build their own portfolio with a rental unit here or there. And for me, I started with the first one, and we had a rental unit that we still have that we lease out, and we have quite a few others. And I think from that perspective, that gives me the knowledge to help our clients who do want to be in the investing. And you were, go down that route. And when you were utilizing the different avenues of generating business, how better than to look at your book of business you have right now, who may be folks that you've sold their primary home to, and maybe in the back of their mind, they're thinking, hey, I want to pick up an investment property here and, have a rental property and what it might be. Start mining your own people, because you'd be surprised if you can impart your wisdom that you've done yourself personally, right? You want to experience it yourself, so then you can help others understand, because you have that firsthand knowledge how to help them. Then suddenly you have clients that you've worked with in the past, they trust you, they're listening to your advice on this, and then you've now created a new avenue for them, and you've now given your clients a new wealth stream as well that they can build on. And that, I think that would go miles and miles to help clients like that. And suddenly now they want you to help their friends and to build the same wealth stream through investing, residential, commercial real estate, whatever it might be. So that's my biggest takeaway, is really kind of trying to look at my own database from all the folks that I've helped all these years and try to put them in that same position to build and create their wealth as well for long-term with their goals.
Oh, that's great, Dee Dee. Yeah, right. And then you're giving back to them, and it comes back to you, as well.
Absolutely. Yeah. So, well, we are up to 2:10. So we're a little over, but I thank everybody for your participation today. And Michael, it was fabulous. I'm not sure you took a breath the entire time. That was a lot of information, and we really greatly appreciate it. And as a reminder, everyone who was on today, we are sending out the slides. Some folks asked about doing the calculations. Michael did have some pages in there that had the worksheets that you can create the calculations, and he did have the answer sheets in there too. And you can work through that. And I would like to also remind everybody, our next webinar is happening on April 1st, and that is no April Fool's joke. And we have Nick Crowder, and Nick is the author of the book, The Golden Handoff. So what Michael was just talking about, packaging yourself and your business and being able to sell that as a product so that you can have your financial freedom and everything in your retirement. That is our third webinar in this 3-part series. So I hope that you will sign up for that one. Again, it's on April 1st. Don't forget. And it's no joke, not an April Fool's. And that will be the next one. And we're super excited and hope to see everybody back again on April 1st.
And
Thanks
just to
so
add
much.
to that, Dee Dee,
Yeah.
when people wish to sign up today for Nick Krauter's succession planning webinar, if they go to the front page of our website, we do have a banner for that. Just click on it and we'll take you to the registration page.
Great. Good deal. And check out Michael's website as well. If you have more questions or you want to get some of those classes in, I think there's a lot of great information there for everyone.
Thanks, TD. In fact, if you want to, I saw a couple questions on the courses and discounts and things. So just go to Dana Education. It's education at thencrea.com. Education at thencrea.com or the website. But if you go direct, there it is. Perfect.
Hey, good deal.
Good deal.
Dana's quick on the draw. Thanks, Dana. All right, good deal. With that, I will wrap up today and thank everybody for being here and have a good rest of the week.
Thank you so much,
Bye.
Dee and Dan
Thank
and everybody.
you.
Thank you for your time. Have a great day.
Take care, everybody. Thank you for attending.